What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online as usual. Today I want to. One of the members in our Discord, and if you're not a member, in the description, there's a link to our Discord in the description of this video. Um, One of the members there has mentioned this site Concrete a few times. We've also had other where they're actually, if you invest on here, it looks like this is a private REIT. Um, and they tell you their annualized returns up to 7.39%. When I actually dug into their numbers just a little bit more, it seems like most years they've underperformed that by a decent. People have brought up a lot of other platforms similar to this, where you're investing in a private REIT. It's not really fractional real estate. I think Concrete does have this other option in their investment where you can buy. It looks like maybe buying into individual homes, but I'm on the wait list for that, so I don't really know. But so I just want to talk about. This got me thinking about, you know, this is a nice passive investment. If you think about it, so is like Roots. Um, I think Real Shares is like this. So there's a whole bunch of these private REIT companies where you can invest in REITs. You get some return. You're not really having to dig into any properties. It's just you're buying into this pool of properties. Uh, I did another video about why I don't invest in REITs, and so that it's just not really for me. But I want to dig into a little bit about. I'm going to go back to Lofty, and I know I spend a lot of time on Lofty compared to all the other sites. I want to show you what some of the numbers look like and why I keep spending time there relative to what we get here. So for example, right, if you take their best year, 7.39%, right, that's their annualized net returns up to that amount. One of the reasons that they're not getting better returns of that is it looks like they have quite a bit of expenses when I was looking at their finances. But like if you look at Roots was very similar, and when if you look at the actual payout from Roots, it's even lower. If you look at and then even some of the other fractional sites that are like Arrived or Real Bricks and stuff, they're giving you these real sort of lower returns, but it's because they're trying to provide a little bit more of a turnkey process and a little bit safer. Um, at least that's the pitch, right? For Arrived, it's a bigger company. They have this methodology where they're picking properties. You can basically take all their properties and, that's the thought process, right? Uh, but whenever I'm looking at those and I tell you like, oh, well, I'm not invested in this site or that site, and partially it's because all the additional fees that are built into some of the regulatory compliance, either from selling individual properties or from having a REIT, uh, all of that administrative expense is what crushes the returns and why they end up being so low. At least it's a big part of it, right? And so what I wanted to just go over today is actually some of the numbers of what I expect to do on Lofty with some of the different strategies that I'm using, and why, why I'm really focused on the discounted token strategies, which I think there's really two different options there. Um, but what I think returns will look like, and so far what they actually have looked like. Um, so I want to dig into a couple different things. So one of the reasons that you might want to have one of the more passive, either private REIT structures or something like that I can think of is, okay, you just want to buy something and hold it long term. So what I'm going to do is I'm going to look at three different scenarios, the three different types of properties that I'm buying on Lofty, to show you what I think that my expected returns are. And I want to point out, this is my expectations, right? I'm not telling you this is how you'll do on these sites. Just because I'm investing in this platform and any of the other platforms that I have links to in the description to this video, it doesn't mean that you should. You should do your own due diligence. Come up with your own, both on the platforms themselves and on the properties, and come up with your own projections and figure out, for individual properties, how you think you're going to do. But so I've basically been doing one of two things on Lofty. I'm either buying properties that have zero yield or very close to zero yield, but are at a really big discount, or I'm buying ones that have sort of a mediocre, maybe high single digit or 10%, somewhere around 10% return. also at a pretty good discount, but not quite as discounted. What I'm not doing and what I'm most of the time passing up are the ones that come to the platform paying full price, the $50 tokens. But a lot of those come to the platform with a stated 20% yield. And so I'm going to make some really gross assumptions here, some very, like oversimplified assumptions. One is that, that 20% yield stays 20% the whole time. I think that's a very poor assumption to make for a lot of the properties. And, when I do individual due diligence videos, I show why that is. So I'm trying to do, I guess, maybe I'm trying to do too much in this video, but I'm trying to do two things. One, I'm trying to show why I think the opportunity on Lofty for me is just a lot more compelling than on a lot of these sites that have like the high single digit returns. But also why the discounted token strategy I think is the opportunity on Lofty. I don't think buying the $50 par tokens that might be yielding 20% when they're brought to the platform is really the way to make money on here in the long run. And so I'm going to look at each one of those property types, right? Each one of those purchase types, but also look at some different scenarios. So first, I'm going to look at 5-year, 3-year, and 1-year holds, and what the IRR looks like. An IRR, internal rate of return. If you don't know what that is, that's just looking at what your return is over time. So you're basically it's an annualized return. So it's one of the easiest ways to compare different types of investments. And so you can somewhat safely compare this IRR to that like 7 or 8% return that you're getting on those other products. Because if it's one that's like the total, some of them are saying like, their dividend plus their appreciation, what it's going to be. And as far as that concrete one, that looks like it's actually the goal is just cash flow. And so I don't believe there's really a lot of appreciation built into that model because they're investing primarily in debt. Okay, and I'm going to give you a couple of examples of what I think is each type of these properties. So this one, Sarah Ave, it's in Akron, Ohio. I think this is, it does have some rental yield, but this is more like the very discounted token strategy that I'm using. So it does have some yield. It's not zero, but I just am using zero because these are sort of like general ideas about types of investing. But there's no perfect home that's going to look like this. And this is $20 per token, not 25. But I also think the full value of this property is probably not $50 per token. It might be like 45 or 48 or something. And that's one of the assumptions that I'm making, regardless of the token price, is that the underlying real estate is worth about $50 per token. And that's something that on every single one, that's not a safe assumption to make when looking on the platform. That's something that I'm doing due diligence on, and that's part of how I'm picking properties, right? Is I'm comparing the real world asset value to the current token price and seeing what that is. But so this isn't a perfect match for this strategy, right? Because it's showing a little bit of yield, but it's also a little bit more discounted. But it is, I think it sort of fits into this zero yield type strategy. That's what I'm just calling this. The 10%, and kind of look at ones like this Estes Street property. Another one that I'm buying into that I've mentioned a few times is Garden Gate. That's one that's got somewhere around a 10% yield, and although it's a little bit lower, and I've been picking up tokens around $30. And then this Murray Ave, the Atlantic City short-term rental. This is a relatively recent one that came out. It's exactly a 20% rental yield. Starting price is $50. Now, one of the assumptions that I just said was the property's worth about $50 per token. We've seen on a lot of these when they come to the market, it's sort of an inflated asset value relative to the appraisal. But that only makes this one worse, and it's already the one that I'm going to tell you that is not my preference. So it's not terrible. So if I were going to hold these properties for 5 years, and I'm assuming no appreciation, and I'm going to go into a few different things, but I'm assuming no appreciation. uh, buying this 20% yield. And so, okay, we're not expecting any appreciation, and we believe this 20% will last the whole time. We won't have any dips in that yield. So far, that has not been a safe assumption on any property that I've looked at. I haven't seen any that have had, a very long period of a 20% yield. I think there will eventually be some exceptions, or there could be. But in general, the yields tend to degrade if debt gets paid down because you get diluted, or they just happen to get worse over time because there's some capex or there's some vacancy. Um, but assuming everything is perfect, if you have a 5 year hold, that strategy, that 20% yield strategy, and assuming that everything goes perfect, it does end up being a 20% return, right? You sold, you had no appreciation. This is a very simplified version, right? But even with even with all those things being said, you're only beating the zero yield strategy. It's a 15% versus 20, right? And so this is just because I bought at a big discount. I'm assuming no appreciation, but in year five, I'm actually getting a real world sale where I net $50 per token. And so yeah, you might say, well, maybe there had to be a little appreciation to combat selling fees or whatever. But this is I'm trying to do a very simplified version just to hold. So okay, in that scenario, if I was trying to buy something, not touch it for 5 years, um, and then that's when I sell. In any with any of these three strategies on Lofty, assuming things go well, you are crushing the returns of the stated returns on a lot of these other platforms that I'm passing up, right? So they're saying, oh, look at it. It's, even Collab. I mean, a whole bunch of them are like, you're going to get these. Well, Collab does say, they pay out a certain amount, but they say they're going to have this big amount of appreciation. So, maybe they will. It's really tough to compare a lot of the different ones. So for the most part, if I'm passing on one, it's because I'm believing what they're telling me, and it's just not exciting, right? Um, but so this 5 year hold, I think, any of those end up being pretty good. Now, obviously, things can go wrong. That's why we want to dig into the properties. That's why we want to make sure they're managed properly and everything like that. But I'm not somebody who's going to just buy this and sit here and not touch it, right? Like I am going to touch them. I'm going to come up with different proposals, maybe switch managers, maybe try to sell. You've already seen, I've been involved in the Dresden sale and the 175th Street, the Keeler one. I think we're going to sell Odom. We're in the process of doing that. All of those ones were just very discounted tokens, um, for an extremely short-term hold. And so, you saw, like on the Keeler one, that most recent one, the IRR on that was like 122%, right? So, but let's say, okay, not all of them are going to be perfect. You're going to end up selling out, having to hold some a little bit longer. Maybe, like maybe Odom, for whatever reason, we don't get to sell it this year and it limps along for a couple of years. Well, what happens over time, right? Like if we end up with a 3 year hold, because I'm kind of stuck a little bit longer. But again, I got to buy it at 25 and it's worth 50. Again, assuming no appreciation, um, with your 3 year hold, you end up getting, 26% IRR with zero yield, assuming I never get a dollar of cash flow. In these examples, though, you have to at least have enough income to cover your expenses. So it might be zero yield, because you got a little bit of rent, it covered your expenses, but it didn't, your taxes and insurance. So this isn't as if I'm holding a vacant property for 3 years. I'm just holding an underperforming property for 3 years, and that's kind of in line with what Sarah is, right? Like it's not vacant, it's just not paying out much yield at all. Um, so on a 3 year hold, you end up getting, the zero yield deal ends up being 26%. So it's actually not quite as good, excuse me, as the one that's paying the higher yield, the 10%. But it's already, even with a three, still have being stuck with it for 3 years, you're already beating the $50 token ones, because again, you're just topping out at 20% there. Um, I think that my ideal on Lofty so far has been to really push for sales relatively quickly. And the reason why, and you can see here, if you're able to buy at the discount and sell within the year, your actual returns end up being significantly higher when you annualize them. And if you get to keep rolling over your money, you do get to annualize them, right? And so in that scenario, if you're able to continually buy at 25 and sell at 50, you could realize 100% returns, annually. Now, are we gonna run out of these deals? Maybe. And do they work out this perfectly? Not so far, right? Like I think, although the Keeler one was 122% return, annualized. I think Dresden was like 97 for me. So I mean, they're very close to hitting that number, because it's a shorter time frame, and I'm getting less than a double, but like a third or something like that. Um, because a lot of times you're not actually realizing that $50 token sale on a lot of the ones that I've seen so far. But also on a lot of them, I'm not paying 25 bucks per token. Some of them are more. Odom, I'm paying closer to 30 on most of the ones I bought there. So it'll be a smaller return. But in general, I think, over time, as long as you're churning the properties, and then realizing that real world sale, and buying at the discount, you can start to see like the zero yield tokens, the tokens that start off with no money, um, do significantly better than the ones that you're paying full price for with a really high yield. And again, I'm assuming that we never turn this around, right? Like, what happens if, okay, we do get stuck with a 5-year hold, and I get paid, 5% over this time period, right? Uh, which is a still a smaller yield, but still a yield. Okay, then this is looking really close, right? Um, and this is the sort of stuff that I've been playing with a lot to try to get an understanding of when I didn't even add it in all of those, right? Let's do it. So this would be a 5% return or a 5% yield. Um, Yeah, and I mean, even if you get to turn around and you get to buy that discount, and you get a little bit of income, not a ton of income, but a little bit of income, all of a sudden our zero yield deal, because of the discount we bought it at, you end up selling it, at the end of your hold period. It's pretty easy, um, to get to a similar return of these ones that you're paying full price for, and the difference being, if you're forced to sell earlier on these ones, you might end up losing money, right? I mean, here you're showing, okay, we're actually going to make our 20%, but if something happens and we have a forced sale early in our process, maybe we need to liquidate because of something happening in real life. Well, all of a sudden, you end up just way better off with the other. But I want to add a couple more things into this. Okay, so this was ignoring appreciation. Let's say we just have a 3% property level appreciation, and so it's worth 50 a year. At the end of year one, it's worth 51.50, all the way up to year five. Oh, before I forget, please like and subscribe. In the description to this video, there is a link to our Discord channel where we have discussions about a lot of these different platforms. There's also links to all the places where I'm currently investing in fractional real estate online. Again, just because I invest on some of those sites doesn't mean that you should. You definitely want to do your own due diligence. And same thing with individual properties. Even if you pick to invest on the sites, really dig into each property if you can. That's another reason that I don't really like the REITs, is because they don't even tell you all the properties that they own, right? So you can't do that same level of due diligence. Um, so I'm much happier being able to actually pick one property, figure out what this property is worth in real life, figure out that I am getting a discount on it, and then getting to do some math around that, making some assumptions. But so, okay. So now, on my year five or year three or year one, I'm just using whatever the appreciated property value is. And again, we're ignoring sale costs here. I'm just doing very simple math. Um, when I'm looking at individual properties and trying to, estimate what I'm going to make on these deals, of course, I do want to make the individual calculations a little more complicated. I do want to think about what I'm actually going to sell for, what the sales costs are going to be, Um, do I think it's really going to yield zero? Am I going to get a little bit? Is it going to be a negative yield where there's going to be capital calls that dilute it or something like that, or where there's debt at the end, right? All of those things we want to think about on the individual deal basis. Here, I'm just trying to think about three types of deals in general, like sort of the ideal versions of those, and then, as a way to compare them. And so, like I said, I mean, any of these numbers, if you think about it, far exceed what I think I'm getting on a lot of the other platforms, or what a lot of the other platforms are telling you you're going to get paid, right? Um, and again, you can't just go on Lofty and pick any random property and make this kind of return. If you look on the marketplace, and I want to make sure I'm not like overselling this, right? Like if you look on the marketplace, more than 50% of the properties, and I think it's actually like almost 2/3 of the properties are selling for, the token price is less than um, the $50 price, right? So meaning that people have bought at $50 and lost money. So, right, the only way that this works for us as investors is because some other investor lost money on this holding, right? They bought this at 50, I bought it from them at 25. They bought it at 50, I'm buying it from them at 15, right? Like, so it's definitely a site where you have to do a lot of due diligence. You have to dig into each property. You have to understand who the manager is. You have to understand what market it's in, what the condition of the property's in. So yes, I'm not, it's not a apples to apples comparison because isn't passive. I'm spending time on it. But in my mind, it's worth that time if I'm getting double or triple the return on it, right? If I'm going to do, and in some cases, I mean, this is why I really like the active strategies. I think in some cases, am I really going to average 100% return over time? I don't think so. But I think it will be, um, I mean, it sounds crazy to say it, but I think like 30 or 40% average returns on the really discounted tokens that I'm buying um, is an achievable goal. And it's part of it is too, it's you can't, if I were once I move a whole lot of capital onto the platform, it might get a lot harder because there's always only so many discounted tokens. At the same time, I expect Lofty to continue to add properties. Um, and one of the things I used to be worried, like, oh, it's really just the legacy properties that are super cheap, right? Like, you're not going to get these discounted properties with co-ownership properties. Oh, what am I doing there? But let's look, because you can actually sort these. Oh, no, you can't sort them by co-owner, right? I thought you could. Hmm. Um, but there are properties that are co-ownership properties that have sold at decent discounts as well, and not a ton of them, but they exist. Oh, I know I can think of at least one. Um, so this is a co-ownership property, right? And it's selling right now at $39. So it is currently giving paying a yield too, right? It's not a zero yield. It's not necessarily uh it doesn't fit quite neatly into one of my boxes, but it is a discounted deal, partially discounted, partially decent yield. It is one that I've bought some of and will probably buy more of if it dips more. So I think that even having the co-owners there, um, it's not stopping us from having deals that come on and then having token prices that tank for one reason or another. There's definitely a bunch that have gone down to like, yeah, like this one is another one that I'm buying. The yield is not great, but it is a good discount. And I actually think this one might be even more than 50. Well, no, this isn't the one. But some of these I think will be worth even more in the future. But so that's what this one's looking at, right? Like if once I throw in appreciation, I got way distracted by that, sorry. But once I add in the discussion about appreciation, so these ones are the same, it's the same chart I did up here, but now I'm just appreciating that token price. Um, you see now, again, assuming $0 in yield on this one, it becomes very close to the 20% yield one because the discount that you're getting, it's still, if the property is still worth $50 in real life, which I think on a lot of them they are, then that, the appreciation is going to happen on that $50 price, not on your $25 price. And so you end up getting, now we're really close to the same yields on a 5-year hold. As soon as it shrinks down to 3 years, you're way, you're outperforming by a significant amount with the two shorter term holds. And then again, if and this is like the Keelers and the Dresdens, and you're getting just unbelievable returns on a very short hold, right? Like this is for a full year, but if some of these have been even shorter for me. Um, and you're like, oh well, then I have to go and find the next one. But so far it hasn't been a problem, right? Again, once you have a ton of capital on the site, it might be difficult to be able to continuously redeploy it. But at the moment, we're with the amount that I'm playing with on here, that hasn't really been a problem at all. Um, and like another example of this, 10% yield at $30 is even where is it? Uh, I mean, even the Leclerc tokens, that once they've hit $30 a few times, and that gives you close to a 10% yield. Now there won't be any property appreciation if you end up holding that one, right? It might really just turn out to be a $50 token sale plus the $3 that you get that year in yield. But I mean, there's just all these different opportunities to do that, and so that is why, despite all of the scandals and like the arguments and all the different stuff that goes on this platform, and the potential to really lose money because um, you know certain things don't work the way you think, or certain properties weren't managed well, whatever it is, despite all of that, I still believe that this at the moment is the platform where I'm going to get the best returns. As an active investor, right? Like as someone who's looking at deals on a regular basis, who's doing my due diligence, who's selling when token prices pop, right? That's the other thing that doesn't really even come into play when I'm looking at this. Some of these deals, like for example, where is it? It's probably around $28 today. Yeah, like Sangamon, right? This one has been one. It was a zero yielder when I bought it. It's a 10% yielder now. So, still matches up. Like this matches that buy it for 30 and have a 10% yield type description. Um, but this price has moved so much. Like I was buying it at 22, selling it at 34, buying it again at 22. Like that is the opportunity of being an active trader on here that you're just not getting anywhere else. I mean, there's not another platform right now that's letting you buy and sell these assets around, knowing that you have a property that's worth, you know, $50 per token at the end of the day. And I'm using that as an example. A lot of them, maybe I think it's actually going to be $38 per token, or 40, or whatever it is. So some of these, the liquidation price is lower, then that just means that the price that I want to pay is lower, right? So if it's 40, then I want to pay 20, if it, or whatever the discount is. And I don't even need to, I mean, this is doing a 50% discount. Um, some of the tokens are more than that. Like you can see, like the Sarah one is more than that. A lot of them, I picked up a whole bunch of tokens in the teens not too long ago. And then, some of those have sold out of. I have to be really careful with those because some of them are in the teens because, well, there's one right now that doesn't even own a property, right? There's people that own tokens. If you didn't see my video yesterday, you might want to check that out because that's absurd, right? So there are huge risks involved. Like there's definitely, if you're not doing this, really paying attention and focused, then yes, maybe a site like this makes more sense for you, and you just get a lower return. And although honestly, when I dug into this one, it wasn't my cup of tea. Again, it doesn't mean it's not right for you. Um, I'm just not a fan of private REITs, right? Like if I'm going to buy a REIT, I'd rather just own a publicly traded REIT. I think that there's just more scrutiny. There's more scrutiny from like big buyers and like analysts, large investment companies. So I'd rather have that oversight, and you can buy public REITs that have dividend yields that are at least that high. So I don't know why somebody would choose the private REIT over that, other than they just have good marketing. or they make the liquidity easy. Sometimes there's reasons that people do it, but I think from a pure investment standpoint, it's hard for me to understand why they would. Again, might be the right choice for you, but it's, for me, I'd much rather do this. Now, why don't I just stick all my money on here? Hopefully you've been following my channel for a little while, and I really am still just experimenting on Lofty, on Mogul, on Ground Floor, on all the ones that I'm putting money on. I think that, I'm spending more time on the ones that seem like they have more potential to me. Um, and that I think, Lofty's one that I have the most money on at the moment. It's still not a ton of money, but it's enough. There's just so many different opportunities, and I really am trying to get a good sense of like how real they are. But over time, I'm getting more and more confident. As I've gotten more real world sales and have more lined up, I've really become pretty confident in my ability to spot the ones that I think have a good potential to have these real high returns. Now, is it gonna, am I gonna have some losses and my average return ends up being lower? I think that's possible. Um, I don't think that it's possible that it'll be so much lower that I'll end up at that single digit returns. Um, Only time will tell, though, right? I mean, that's a little, hubris on my part. Maybe it's possible I've gotten lucky on my early deals on here and that future ones are not going to work out as well. Or that maybe once we work through all these legacy properties, there won't be as many like deep discounts. And that's fine with me. I mean, that's kind of why I'm also working, well, experimenting with Mogul because their projected returns are significantly higher. Most of them are in the mid-teens, so significantly higher than a lot of the REITs out there. But I'm still able to dig into individual properties, um, and decide for myself, do I think their projections make sense for what they're buying and what market they're in and everything like that. And so that's, I know if you've been watching this for a while, you've heard me say most of this stuff before, but I just wanted to, put a little math to it, show the different options as far as like the way I'm thinking. These are basically the different investment buckets that I have in my mind when I'm looking at tokens on Lofty. Where do they actually fit into my investment strategy? And for me, these two are the ones that I'm really taking advantage of, and I have very few that fit this criteria, right? And not none, but very few. And I think even at least one that I bought thinking was going to be this is slowly turning into a discounted deal, which is one more thing that I actually like about Lofty, right? Like, I bought my first tokens in this property, KD Ranch or DK Ranch. I think I paid close to 54, maybe even did pay 50. I'm not sure. Um, just bought a couple at that price, but as it's dipped, I've bought more. I think that, having the ability to make a decision, think it's worth something, and as it goes down, buy more and more of it is something that you can't do with real estate in real life. It's much more of like a stock market type of strategy, but it makes it so, you can get some, um, basically just average down your basis and get a better return overall. Now, obviously, those first tokens you bought were still not a great investment, maybe relative to all of them, but I think that having done that work up front and deciding, okay, I'm okay with this at 50, once it gets to 40, I'm real excited about it, right? And so that's why some of them, as the prices start to dip, I buy significantly more than I did at the higher price because at that point, I think a lot of the risk has been taken out because a big move to the downside, has de-risked it a bit, right? A lot of whatever made that happen is typically because some unknown risk became known, right? Like maybe it's that though the yield really wasn't what it should be, or there was some property issue that we have to take care of, or whatever it is, right? Um, I took way longer to describe, to explain all this than I planned to today. Hopefully, this was helpful for some of you to think, just to share how I've been thinking about this and what I think the opportunity is. And again, I mean, this is the area that I think I'm playing in, right? And here and in here, some of these markets I don't expect any appreciation in, and so, but I really believe that on a on a annualized basis, there's this potential to get just unbelievable returns on this platform, at least right now. Is that going to how it's going to be going forward? Only time will tell. It might get harder and harder to pick properties that other sellers are willing to sell. Although so far that there hasn't been a lot of pushback when I've identified ones. It's just a matter of having a vote and pointing out, hey, this is going to be worth more than we think, and why don't we go ahead and sell it? But in any case, I just wanted to share all that for today. Uh, I'm really going to stop. It's a long one. If you're still watching, I just want to say I really appreciate you watching the video. Please do like and subscribe if you haven't already. And until next time, I'm just going to keep making mistakes so that you don't have to.